This Make or Break Hour begins with the rally. Take a look, the scorecard. With 60 minutes to go in regulation, that 4,400 level on the S&P, we are above that. It hasn't closed above there since back in September. So we're going to watch that over this final stretch. Elsewhere, strong across the board. A big reason we're here today, mega cap tech. Several of the big names with really nice gains today. Apple around $185 above that level. Look at Microsoft. Another new all-time high today. And NVIDIA back above $480. That's near 7% over the past week. And that's where the move has been the strongest. As a result, NASDAQ, not surprisingly, the outperformer as it has been for the entire year. If there's a knock this week, it's the Russell 2000. It's been mired in a long and painful slump, even though higher today, as I just showed you. Small caps can't get much going lately. They're not the only sputtering sector of stocks, that's for certain, which leads us to our talk of the tape. Does it matter? Does it make a difference to the rally if it continues to be led by the biggest names in the market? Let's ask Adam Parker. He is the founder and CEO of Trivariate Research and a CNBC contributor. Look, that's the knock on the rally all year. Does it matter or not?
Not really. Not really. I mean, if you're trying to beat the S&P 500, then you have to own a chunk of those names. We've been saying that for a couple of years. And if your job is to, beat the S&P, you got to risk manage those names and get your alpha elsewhere, right? So, as we've been saying, it's very unlikely, I think, in the next 3 to 6 months that the small cap companies are going to have more achievable estimates or have more margin expansion than the big seven. It's just unlikely. Why? Well, you need wages to be more beneficial, commodities, depreciation, pricing, and mix. The small cap companies just don't have as much of that as the big ones. So I think it's going to be hard to have a big market rally and not have the Magnificent Seven pro rata participate.
Well, of course, but it's a matter of the other stocks that are not participating. Look, when the S&P was at 4,000, people hated it because they're like, well, it's only being led by the seven stocks.
Right.
And then when it was at 4,200, hated it still because, well, it's a Magnificent Seven and nothing else. Well, here we are at 4,400, and in large part, it's the mega cap stocks and kind of everything else. I mentioned what the Russell's doing lately, and it's ugly. And a lot of these other sectors, energy's done nothing, healthcare's done nothing.
It depends on who you gathered the money from, your investors, and what fees you charge and what your mandate is. But if your mandate is long only beat the S&P 500, you absolutely have to own at least a market weight of the big seven. You don't know anything about them. The idea that somebody knows something about Google that isn't in the price, I think, is rough. Or Microsoft or Apple. They're covered by 4,000 buy-side analysts and 60 sell-side analysts.
I know, but at what point do these stocks exhaust themselves?
When their earnings,
and then everything else
are less achievable and their margin expansion and growth is less attractive. You know what the answer is? When things get much worse and 6 months before the accommodation's coming, then you buy small caps because they're going to recover more lower quality and smaller cap stuff work. So if we still think they're going to raise one more time, or we're still at that part of the cycle, why am I going to go all the way anticipatory to 3 to 6 months before? So things have to get way worse before that works.
So you're saying it's too early.
Way too early. Yeah.
For small caps.
That's right.
Because they haven't troughed yet.
Yeah, they haven't troughed yet. There's enough pain in the earnings. Earnings are pretty good. I mean, they're okay. So, you need earnings. I think, X Energy, they're up 7% so far this year when people were calling for down 5%. So the answer is you need a lot more pain in the economy, a lot more pain in earnings. You need to dream that accommodation's 3-6 months away. Then you get in, you buy the low-quality stuff that's going to survive, the small caps that then have a runway for margin expansion. But sitting here at this point in the cycle, no, and I don't think that should be surprising to people.
So simply the Fed potentially being done is not enough. And that's the central question we ask ourselves every week, because there's a new Fed speaker every week, including Mary Daly.